Welcome to the Investing Mastermind Podcast. I'm Signe and with me I have Michelle Markey and a very special guest. Before we say hi to you, I want to make sure that the listeners get a good understanding of the very special guest we have with us today. Because last year, Michelle and I, we went to Warren Buffett's annual meeting and everyone was raving about fund manager Matthew Peterson's backyard barbecue. So this year, Michelle and I, we were able to go and get an invitation for the event. And that's where we met Matthew for the first time. And now I'm a raving fan.
Yeah, we are so excited to talk with you, Matthew Peterson. You're amazing.
Yeah. So Matthew has succeeded in gathering a group of extraordinary, wise, and kind people for this barbecue. There's investors, his clients from his fund. Matthew's own family was there. It's a truly outstanding event. The barbecue setting is just a brilliant way of meeting some of these fantastic minds. At the event, I also managed to get a hold of your latest annual report, Matthew. And it's from Peterson Capital Management, your company. And what a treasure trove of information in here. Matthew is being transparent about every detail of his fund's operation. And I got so inspired from the structured dividend capture. And as a passionate options trader myself, I can't wait to try it out. It's a more advanced strategy, and many of the listeners here are beginners, but even beginners, there's so much gold to be found in this report. Thank you for sharing everything so openly, Matthew, and welcome to the show.
Thank you, Signe and Michelle. It's really nice to see you again. Thank you for the very warm introduction.
So, Matthew, please tell us a little bit about yourself and how you were drawn to investing.
Great question. I have been a value investor since a very young age. I was always passionate about numbers and finance and economics and business. I studied economics and math in undergrad and went out to Wall Street and started consulting for investment banks, primarily Goldman Sachs, where I was working in the risk management groups for a number of years. About 7 years, I was between Wall Street and London and earned my CFA designation there, always with this intention of setting up my own fund, very much in the style of the Warren Buffett original partnerships. So we've now been in operation for 12 years and we've been growing. So it's been a great journey and we're very pleased with all of the success.
Congratulations on an amazing track record since 2011. It's just amazing to be able to learn from your letters and all of the materials you're willing to share with everyone online. You're just super generous and kind. So I personally am so grateful to be able to learn from you. And I was curious, how did you discover Warren Buffett and Charlie Munger specifically?
Yeah, well, these are two of the most profound investors in history. So you don't have to look too far to know where to start studying. I've been following Buffett since I can remember, but for probably 25 years, I've been very interested. And I think I've been a shareholder of Berkshire Hathaway for more than 20 years now. These are two of the most profound, as I mentioned, investors. And you don't have to look too much further to start getting a really good insight into value investing, which is the real way to invest. I mean, value investing simply means buying something for less than it's worth. And that's what investing should be. So all intelligent investing is value investing. And these two are the masters. So there's a lot of great material and information about both of those people.
And you speak about value investing, and that's the only real way of investing. What are some of the key principles of Buffett and Munger's approach to investing? Can you speak a little bit to the listeners about, some of the principles that you're an avid follower of?
Why don't I take a step back and talk about for a moment that this misunderstanding around finance, the S&P 500 has been appreciating for 15 years at these unprecedented rates. And so I think there's too many folks out there that are sort of expecting 10, 12, 15% every year from an index fund. And that's just not sustainable. Specifically, you look back historically over several decades, a century. Jeremy Siegel goes back 2 centuries and shows that the rate of return is 6.8% plus inflation. So that's why you always see these sort of 9 and 10% figures. Meanwhile, over the last 50 plus years, Warren and Charlie have managed to compound capital at 19% annually. And it's not a consistent year over year. That's the average over a series of years. So they also have volatility. And in a company like Berkshire Hathaway, over the last 50 years, they've seen declines in the stock of more than 50% on 3 different occasions. So to achieve this 19%, they have to withstand all of this volatility along the way. And that, in part, embodies a lot of these value investing principles. You need to have patience. You need to truly understand the intrinsic value of the business. And you're trying to find an opportunity to buy at extremely low prices. And you're looking for a great company with great management teams that are actually growing into the future. And so there are so many different principles. We can get into any number of them. But ultimately, I think it's important to consider that very few funds and fund managers, very few professionals are able to outperform the S&P 500 over the long term. And that, even fewer retail investors are able to do so. So you really have to consider what opportunities will fit your own personality. So as you're looking to invest, you sort of have a few options. You can go the index fund route, which is a very good route. It's probably going to outperform most of your other options. You can find a extremely talented fund manager to help you along the way, or you can try to do it on your own. And the challenge with doing it on your own is that by just looking at the numbers, most people truly fail to outperform the S&P or especially Berkshire. So with that knowledge, something that's very interesting is that Warren Buffett and Charlie Munger have been buying the companies right out of the S&P 500 and putting them into their own Berkshire Hathaway. They actually remove them from the S&P 500 when Berkshire buys the company. And so if you think of Berkshire Hathaway as a collection of, say, 100 businesses, and they bought many of them directly out of the S&P 500, so the index no longer holds those businesses. They're now held within Berkshire Hathaway, and Berkshire Hathaway is itself a single company within the S&P 500. You now have this ability to consider whether or not you might be able to outperform the S&P 500 simply by owning Berkshire Hathaway, which is maybe not the fastest growing company in the world every year, but over the long term, you'll do quite well just by holding on to this great asset that has been built by these 2 profound value investors over more than half a century.
Absolutely. And that is an amazing idea to think that investing could just be so simple. Like, we don't have to be distracted by all the many different kinds of equities and index funds that are out there that we may or may not have much of an understanding of, but we could keep it simple just by focusing on very few options. And I also wanted to ask as a follow-up, how do you square away some of the opportunities where maybe the index fund may have gotten ahead of itself if throughout the past couple of years there were a lot of asset bubbles that some may have believed things were getting a little bit bubblicious in not only the stock market or also in real estate, but how would you suggest people proceed? Should they hold some of their assets in cash, waiting for an opportunity for a strong market downturn of upwards of 50% if they hope to kind of achieve similar returns as Warren Buffett and Charlie Munger have done in years past? Or should someone just kind of consistently invest, like dollar cost average, into the stock market and just pick a few securities that they believe are good bets per se for a long-term investment mindset? Or what would you say toward that kind of notion?
I will try to answer it from maybe kind of a barbell perspective. For a retail or novice investor, I would even go on record here to say, I think you will do quite well if you take all of your assets, split them in half, and put half into the S&P 500 and the other half into Berkshire, and you never touch them. I think you'll probably outperform the S&P 500. And I think the two will sort of counteract each other in some ways, because Berkshire Hathaway itself is somewhat of a contrarian investment. They hold a lot of cash for you. It's managed by the greatest management teams in the world. And so while markets are offering opportunities, you can allow Warren Buffett and the folks that he's working with to allocate the cash for you. That is a very strong strategy. It takes no effort. You pay nobody. You can do it all on your own. And I think you will beat many professionals. It is sometimes difficult for people to do something so simple, but you were both at this Berkshire meeting. Charlie Munger was talking to the Mungers, and the immediate criticism everyone hears is these guys are so old. Okay, 99 years old for Charlie Munger, and Buffett, I believe, is 92, maybe 93. These two won't be around forever, but they've built something that will last. And Munger was very specific when he said to all the Mungers in the audience, if you sell Berkshire Hathaway after we die, you will do worse. And presumably the Mungers are quite an intelligent bunch. So if the Mungers are going to be doing worse by trying to trade and outperform Berkshire Hathaway, certainly somebody who isn't a total expert in finance is likely to do much worse. In fact, the people that often shine are those who have gotten lucky in a way, and you tend to hear a lot about them, but you don't hear about all the other people who did worse. And it's sort of a probabilistic distribution, and people are overconfident in this industry. So it's very important to understand where your skill sets lie. This is a world of specialization. So if you're a specialist at architecture, it's maybe more difficult to go into the finance world and start managing your assets. It's a little easier to just put your money into Berkshire and go and make your money elsewhere. And so that is a really fine approach. I think that's a really mature and wise approach, in fact. Alternatively, you mentioned the S&P and how to sort of gauge the prices. Realistically, it is unknowable what the future will hold. Buffett once said, I think he was talking to Howard Marks, and he said that for information to be of value, it has to be correct and it has to be knowable. Peter Lynch used to say, of course, it would be great to know what interest rates will do next year, or what inflation will do next year, or where unemployment will be, or where the S&P 500 will be, but it's not knowable. So there's no reason to spend your time trying to analyze that in particular. Now, there are big ideas that we don't ignore the big ideas, but the future is truly unknowable. We cannot base investment decisions on macro theses, which means the only thing left is to look at the micro. You have to look at individual companies. And the framework we use is we focus on the greatest business models in the world, and then we focus on the greatest management teams in the world, and we're looking for the deepest value. And if we can combine all three of those, we find ourselves in a very nice place where there's a company with maybe really growing sustainable margins, great cash flows. And when they earn those cash flows, they're now directed by an incredible management team. And of course, we're looking to buy those at the cheapest possible price. So this bottom-up analysis is where you want to be, more than a top-down analysis. If you're using top-down analysis, this idea of cost averaging into index funds or at Berkshire Hathaway is really powerful. And that's the most likely to deliver a very good outcome.
Speaking of your fund and how you invest in the fund, you're the owner of Peterson Capital Management, and your fund has done remarkably well since you were founded in 2011, an annual rate of return of 15% on average, I believe. Maybe it's even more this year, actually.
Mm-hmm. It's right about that.
Yeah. Can you tell us a little bit more about your fund's investing strategy and how you incorporate strategies such as options trading?
We are doing a lot more advanced things within our fund. And if anybody is interested in our fund, they're welcome to reach out to me via email or Twitter or a number of avenues. But we are fundamentally based in value. So we hold a very concentrated portfolio of outstanding businesses that follow the same framework I just mentioned. Great business models, the best business models in the world, coupled with the greatest management teams in the world. And then we're buying them at the best prices. And one of the key tenets of value investing is this idea of patience. And part of that is in taxes. Part of it is ignoring the short-term noise. Part of that is accepting the short-term volatility, knowing that the long-term returns will reflect the growth of the business. And so when we can find a great business that's growing, we can take that position. We take a very large position when we find the opportunities. There are not that many opportunities, which is why I will again remark on the fact that if you're out there selecting securities on your own, you need to be very careful, because you really don't want to lose money. If you go down by 50%, to get back to zero, you now need to make 100%. And so it becomes very important that you're focused on the downside protection of your investments. So one thing that we've incorporated is something I call structured value. And this is really a way that we build into the long-term holdings. It's nothing more than a way to lower our entry price. And it's actually an inversion of the way that these products are used on Wall Street. We do apply some puts and calls to our strategy. Some people may be aware that a call gives you the right to buy a stock at a specified price, okay, at a future date, at a very specific price. A put would allow you to sell the shares to a counterpart at a specific price at a future date, 1 month, 3 months, a year, or even 2 in the future. Most people think along those lines. You're going to use a call to buy and you're going to use a put to sell. What we do is the opposite. I write a put contract, I sell a put contract to a counterpart who pays us for the right to sell us their stock that we already want to buy. So instead of paying what a retail investor would on the New York Stock Exchange, we're paid a large premium up front, and then they give us their shares for that price, but they've already paid us a large piece of that stock price. And so we're able to buy and accumulate shares for below market prices. So we use cash secured puts as a tool to move into outstanding businesses. And in value investing, a lot of times we're watching great firms, we're watching great management teams, but the businesses are just too expensive. It always matters what you pay. And you're not going to want to overpay even for a great company. So you're waiting and watching for a company to fall into your buy zone. If it does decline, the price of the options grow. And so right at the same time that we're looking to buy, people also are looking to pay a lot more for protection. And so we're able to sell our puts for an extremely high price, pick up a nice premium, and then we're looking to accumulate the shares on the other side of that trade.
That's wonderful to know. And I think that's an amazing way to lower one's cost basis in stocks that we would love to own, very much like how Warren Buffett and Charlie Munger has talked about. And you want to buy a wonderful company at a fair price, but if you could get it at a wonderful price, it's even better. So I wanted to tie in your structured value approach to also some of the challenges and lessons you may want to share with us today. And in your annual meeting last year, you spoke passionately about SRG, Seritage Growth Properties. However, the tone was different in your most recent report. What made you change your mind about SRG?
Look, there are a lot of lessons to learn. So when you go out and try to write one of these contracts and experience this, you maybe won't experience everything. So part of the challenge is that more things can happen than will happen. There can be corporate events. There can be special dividends. There can be spinoffs, acquisitions, and there could even be warrants that are issued that maybe you're not going to receive because you're not a shareholder yet. You'll have a contract to own shares in the future. So all of these things need to be handled with precaution. And so you need to be cautious and handle this with care. But I will give you an example with Seritage. We did very well, partly because we were using these contracts. So in 2020, Seritage, for your audience's benefit, is the REIT spinoff of all of the Sears real estate. So Sears was going bankrupt. Eddie Lampert had put this all together, Sears Kmart together. And prior to the bankruptcy, he was able to spin out 212 malls into a REIT. And those malls are in the current process of liquidating. So every single one of these 212 malls is intended to be sold. And the final cash available will be distributed in terms of dividends out to their shareholders. So we had been watching this for some time. It's owned by a bunch of wonderful investors. Warren Buffett, Eddie Lampert owns a large piece, Guy Spear owns a piece. And so we began the analysis of valuing each and every mall. This is the job of the value investor. 212 malls, they're all unique. Many of them don't have tenants at the moment. Some of them need large construction budgets, but it's manageable. You can go out and find an estimate for your NOI. You can look at the local cap rates, and you can figure out the value of a mall. And if you figure out the value of every single mall and you add them all together and then you subtract any liabilities, you would have the equity that would be available to the shareholders. So in 2020, when COVID-19 was hitting everybody very hard, this asset fell to a very low price. It was down in the single digit dollars, 6, 7, 8. And we were able to sell puts as a tool to get in. So if we sell a put with a strike of 6 and we pick up $1 or $2, our net cost to get into the position becomes 5 or even 4. And furthermore, we don't have to put out the capital. We hold the cash as collateral, which everyone should do. But we don't have to put that cash out for some time, for even a year or so. So our cash started going into Seritage. I think our net cost was about 6, and it went out in 2022. And by 2023, the commercial real estate market had really turned. The financial sectors have turned, and we're really watching everything very closely. We continue to value the malls, and we recognize that the trend was terrible. And the market for liquidity was really declining quickly, meaning that banks didn't have the availability of cash to go out and lend $100 million to someone to go buy a mall. So as Seritage is trying to aggressively sell their properties, the lending market has frozen. So without buyers capable of executing on their strategy, there's some big issues, and they're going to have to adjust things. So we recognize that and used calls as a tool to exit. So just as we use cash secured puts to get in at a very good price, when we're looking to exit, we'll use covered calls. And because of that, the share price might move from 8 to 9, but our gains were from 6 to over 11. And that's the real power of using this strategy. Many value investors kind of ignore that this is possible because options sort of are considered speculative or risky. But if you look through the history of Berkshire Hathaway, Warren Buffett himself does this strategy, applies this strategy. So when he was buying Burlington Northern Railroad, he was selling puts to pick up all the premium as he's buying the railroad. And when he was buying Coca-Cola in the 90s, he was selling puts to accumulate his Coca-Cola. So this is a strategy that Buffett not only would use, he does use. And when I was going on too long here, perhaps, but when I was at Goldman, I brought this strategy to him. I was working with all of the different trading desks, helping them analyze the risk exposures of their different products and things. And it was really obvious that if we just combined these two products and sort of operate at the intersection, there'd be a whole lot of opportunity there. But we did an analysis on the market size. And for an institution like Goldman Sachs, it's not big enough to move the needle. They could maybe put $250 million in and be earning $50 million a year. And that's just not enough for Goldman. So what that means is that this is a place where smaller investors can have an edge. Smaller investors can go out and use this strategy to outperform larger investment banks and all sorts of mutual funds and things. And they can truly use this to lower their denominator and get in for lower prices and have great returns as a result.
That is so awesome. And thank you so much for sharing this learning, Matthew. I really appreciate you being open about some of the learnings you also have along the way. A question I have, if anyone in our audience is uncomfortable investing themselves, what's something they should be looking for before they hire a fund manager?
Oh, well, that's a great question. I have a page at the end of our annual report. So anybody, our annual reports are available. All of our reports are available online at petersonfunds.com. If you go into the reports and you look on the last page, there's an amazing individual by the name of Peter Kaufman, who's worked very closely with Charlie Munger for years. He was on the board of directors at Daily Journal for years, and he runs Glen Eyre. And he's put together a list of the 5 aces that would determine a great fund manager. By looking at those, you will really be able to evaluate who would not be a great fund manager. But you want to have someone who has a value investing mindset, a really patient mindset, a long-term, basically a long runway ahead of them. There's always this challenge in the finance world because people want a long track record, but then you don't get a long runway with that manager. So you need to find somebody who's young enough and intelligent enough to allocate the capital wisely. But I think people should look at those 5 aces and use that as a guideline because they are really important aspects.
Well, thank you for that. And also, we just want to ask as one of our final questions, this is the penultimate question of what might be some top books, podcasts you're looking into now or would recommend to others?
Great question. There are a number of wonderful books. You can start by reading Buffett's letters. You can look at The Intelligent Investor, but there's some really fun books to read as well. I like Howard Marks' book, I'm going to blank on the name.
The Most Important Thing.
Thank you. The Most Important Thing is a wonderful book. I also really enjoy Ed Thorpe's book, A Man of All Markets. The lessons that you can take out of Jeremy Siegel's book, Stocks for the Long Run, are really important. And so those are a few that can get people started. You need to study and read a lot, but if you're not going to dedicate your life to doing investment analysis, I think what we said at the very beginning is very important. It's that you can allocate quite intelligently to the S&P and Berkshire Hathaway and outperform a lot of the people who are trying to outmaneuver this growing stock market. It's just so difficult to outperform. And if you can't beat them, you should join them.
Yeah, that is true. So, Matthew, where can people find you if they need to connect with you?
Anybody can reach out via our website, petersonfunds.com. I have been on a number of podcasts and we have a YouTube channel, so people can find more information about us through the website or our YouTube channel. They're welcome to email me, particularly if they're interested in our fund and want to have a conversation about that. I'm also on Twitter, Matt Peterson CFA. So there are a number of channels that people can use. I'm pretty open and responsive, so feel free to reach out. I'd love to hear from you.
Thank you so much, Matthew. It was wonderful getting to know you more and learning about how you suggest, especially beginner investors, to go about what can often be a very confusing labyrinth of investing options and possibilities that, it can be overwhelming, but it's great to hear your calming voice of reassuring people that they have many ways to go. There are many roads to wealth and, leading an abundant life. And you're such a great teacher, and we greatly appreciate your time today and hope you have a great time as you may be going on vacation soon, right? So I hope you have a wonderful time when you go do that.
Well, I'll be in Istanbul, which is actually full of work and a lot of fun. But thank you very much. You actually just made me think of one last point I think might be valuable for your audience. many of the folks that are in the US should know that when they're getting started, things like a Roth IRA are really powerful because the tax ramifications of a lot of strategies we discussed are large. And if you can get money into something that is protected from tax, it's super valuable. And of course, this is a industry, sadly, it's a male-dominated industry. And here we have you two females, and you're doing just such a wonderful job. I think this might resonate with some of the mothers out there, but there are really nice ways that you can, if you have a business or you have a way to hire your children, or you have a way to, in the US, have them receive some form of income. You can hire them to model for your company, for example. You can actually pay them what would go into their Roth IRA or their minor Roth IRA. And we do that with our own family. So we set up companies and they're legitimate firms, and we hire them to do modeling and things. And then we put that money into Roth IRAs. We can sell puts in our Roth IRAs. We're not taxed on any of that. And that money will compound for 60, 70 years before they need to touch it. And it will become quite enormous. And it's something that maybe some of your viewers would like to look into.
Oh, for sure. Absolutely.
That is an amazing piece of advice. Thank you so much.
Yeah.
With that, we're coming to an end. Thank you so much.
Thank you.
Thank you so much for listening to the show. We will be back on Tuesday.
Bye-bye.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.